listening to the Money Monopolizers podcast, helping you take control of your financial destiny. It's about time that we invest more in our financial literacy and work towards building generational wealth. If you think you're ready to do the same, then you've come to the right place. Alex, Marlon, y'all ready? Let's get this bread.
What's good, everybody? It's Alex Camuno here. We're back with episode 78 of the Money Monopolizers podcast. And I'm here with my co-host, Marlon Walls. Marlon, how you doing today?
Man, I'm doing pretty good, bro. And I was actually thinking back on like just what this week had entailed for me, really at work though. So we had performance evaluations this week, and you could be ranked in like 4 different categories. Whether it was like outperforming, then there was like excelling, then there was like successful, and then there was underperforming. And everybody gets evaluated, and they actually evaluated me at the highest ranking. And so that usually entails the highest rate of bonus for the year. And it's crazy to think about just because of where my mindset is today. So that actually equates to a 3.5% pay raise. And in the work environment, that's like very commendable. I'm like, I mean, I understand it, but at the same time, I'm looking at like the businesses that I've built already with like rental cars and stuff like that, even real estate, and looking at what that pays us as well, on top of just the pay raise at work. And I'm like, if you can build multiple streams of income, if you can build a stream of income outside of your 9 to 5, you are essentially giving yourself a pay raise, even above and beyond that 3.5%. You can get 10, 20, 100% raise for yourself if you are building stuff, if you're building streams outside of your 9 to 5. And I think that's really what we are all about, is like not having to rely solely on that 9 to 5 to support your lifestyle. So a pay raise, you can celebrate, but you like, cool, that's just more money in my pocket, because my business is already cash flowing me like that pay raise 10 times over. So yeah, that was just an eye-opening moment for me, just to see it. Well, because I guess I had to preface it by saying this is my first time working for a full year in order to have a pay raise in general at work, because I was always in school or doing something else. And so that was just an interesting first time experience for me, because I'm sure it was different from what most people experience.
Different how?
Different as far as like how I reacted to it, because I've already been building up other streams outside of my 9 to 5.
Yeah, man. And well, first of all, shout out to you for that. That's dope. You know, we usually don't celebrate 9 to 5 events around here, but you know, that's always dope, because I look at it as like, hey, it's just, you know, more money that's gonna go into my business. So I appreciate y'all. I don't care that you've given this to me, but you know, I appreciate it. But that's just my mentality. You know, getting pay raises at work. You know, it's kind of like, thanks. I mean, I had, like I said, I already kind of gave myself this pay raise times 10. So, you know, this is just, they are looking at it as like, hey, you give them that pay raise, that's gonna keep them here longer and longer and longer.
Right. That was the part I was thinking about. Telling like, yo, they probably like, yeah, hey, 3.5%. You should be good and settled in now. Like, yeah.
But you know, and even in that theory too, I actually just did a video about this yesterday, which, oh my God, I was so pissed that I had to re-record it because the audio wasn't, I was so mad. But anyways, like, you know, I mean, that even, you know, when you get a pay raise, that is essentially just accounting for the inflation, in my opinion. That's how I see it. Like, it's like, you're getting paid the same amount technically. You're going to have more dollars coming in, but those dollars aren't going to be worth as much as the previous dollars from the previous year. So, you know, that's one reason that the poor in the middle class, really, okay, the poor that like work hourly jobs and don't have like wage adjusted pay. So if you get $10 an hour, you know, working as the cashier this year, and you're still and then you get $10.50 the next year, you lost money. And you know, in that sense, you know, that's I'm sure why you always hear the poor like, hey, they feel like they can never get ahead. It's because you're holding on to dollars that are losing value every single year. So it's kind of like you can't win in that situation. That's why you need to have assets, which I just did a whole video on that, which we'll be releasing probably, well, by the time this came out, it's probably 2 weeks old now. But this is I think that's still really dope though. So shout out to you for that. But yeah, man, I've been just really investing a lot of my money into some different things as well recently. I did just put a good amount of money into some Bitcoin, so I'm excited about that. I think I'm gonna probably by the time this comes out, my video will have already coming out on why I put $10,000 into Bitcoin. So I plan to record that video this week. But yeah, I did put 10,000 in there this past week, which was a pretty good amount of money. But to me, I did so much this past weekend of research and reading and listening to hours and hours of podcasts and videos just about what Bitcoin is actually, like what it actually is. Even just beyond what we talked about in the episode 73 with shout out to Justin. But I am so convicted on that right now that it's like probably going to become a part of my investment philosophy along with real estate, in terms of, like I say, 9 to 5 to business to real estate. Now it's 9 to 5 business, real estate, and crypto and Bitcoin. So, I got to diversify a little bit because, man, it's just math. At this point, it's just math. It's not even about what do I see it going. It's not about where I see it going. It's about where it's going. Because it's definite at this point. Supply and demand at the root of everything makes it so fundamental that you can't. And by the way, this is not investment advice. You go and, I'm not telling you go put your money in Bitcoin. Like I said the first time we did it, you don't know my risk tolerance. Bitcoin, I very well believe, could go to, right now, it's about 58,000. I think it could go to 100,000 by the end of the year conservatively and drop back down to some 60, 70,000 at some point next year. So if you're not comfortable with taking that kind of volatility, look, that's just something you got to look at. Me personally, it's a long-term thing. I don't ever plan to sell any Bitcoin, like ever, ever. So, in 100 years, when Bitcoin's $1 million, I'm gonna still be holding on to my Bitcoin. And at that point, maybe we'll consider, exchanging it for some other assets. But I'm never selling it because I got scared that I was losing money. It's called diamond hands. They call it diamond hands. They call it laser eyes. That's all it is right now. You put your money up or, don't. That's it at the end of the day. So that's kind of what I've been up to this week in terms of where I would accumulate a lot of my time in terms of my research and just what I've been learning about and studying. So, but I think one thing I wanted to talk about as well, we had a pretty good episode today, and one thing that we did talk about in there at the end of the episode was how things are really changing, and I had wanted to kind of briefly talk about how things are changing right now, just based off the fact that there's so much opportunity right now to get into real estate investing with very favorable terms, in terms of the amount you have to put down, in terms of the minimum requirements for credit score, in terms of the minimum requirements for all these kind of things, in terms of debt to income ratios and all that kind of stuff. It's very favorable right now to get into, and it's not going to be like this forever, because we had recently saw that article about I'm not sure if you had looked any further into it, but I was reading about it, and they're changing the guidelines for a lot of the multifamily conventional loans starting April 1st, which is now in 11 days. So,
when this episode releases, I think this episode releases the day of.
Oh yeah, so yeah, so today, if you're listening to this the day it released, then now the guidelines for multifamily down payments have changed for conventional loans. There's still FHA loans, but for conventional loans, Freddie Mac is now going to start requiring 15% down on some of their loans, which, don't quote me on all that stuff. I still have to look more into it in regards to some of the semantics behind it. But things are changing. That's the whole point I'm trying to make. Things are changing. You could have bought a multifamily prior to that day with 3 to 5% down. Look, now they're saying, whoa. Information is becoming way too available. What are y'all doing? Y'all are moving.
Y'all for them.
Yeah, y'all now the government is like, yo, this is how I see it personally. I look at everything in terms of why did the government do this? To me, I see it as the government is saying, hey, y'all are going to start impacting my bottom line now because the government knows, hey, that W-2 tax income is that number one revenue source. The IRS, which is the Internal Revenue Service, makes 86% of their revenue by taxing W-2 employees and their employers on that tax, right? So now if people are starting to move into that I quadrant, to that B quadrant of investors, that is going to impact the government's bottom line because now they're not going to be paying as much in taxes, right? They're going to start getting depreciation write-offs, which I just talked about recently on Instagram in terms of the power of depreciation. I mean, hopefully nobody on the IRS is listening, but they're definitely not listening. But I'm not going to pay any tax. I'm getting a very favorable tax situation this year. I'll just leave it at that. So just based off of the depreciation and the businesses and all that, I'm very ecstatic about that. All that money will probably go into Bitcoin. But now for in the future, the government's like, yo, y'all doing too much. Y'all got to stay in that E quadrant so I could keep taxing that W-2 income. Stop trying to do all this. Because now, look, information is becoming available. People are learning about stuff. People are moving. People are going to start shifting into that B quadrant, to that I quadrant. If y'all don't know what that is, that's the business owner quadrant and the investor quadrant. People are moving into that. So things are changing. The government is going to obviously respond. So what does it mean? That's why I say as we get further into the information age, things are going to get harder and harder and harder. We are very early right now, but we come on here and talk about this, I swear, every week. Y'all gonna understand at some point that stop sitting on the sideline and get in the game. It's time. You've had analysis paralysis for 13 years now. Get in the game. So, anyways, that's what I wanted to really get into before we kind of talk about the guest today. I'm not sure if you wanted to comment on that at all.
No, that's big facts. Just because of the fact that everything we've been talking about up to this point, we've always been saying that you can do house hacking, single family up to 4 units for as low as 3.5% down. And as times change, as times progress, as more information becomes available, it's just something that's innately going to happen. It's that circumstances are going to change as far as like the rules and regulations, because everybody that's listening to this information, everybody that's getting information from social media, which is where everybody is located at. So now you see your average everyday high schooler getting this type of information. So they graduate high school, not even college yet, with the mentality like, okay, I don't even need to buy a house. I don't need to rent. I want a small multifamily when I get of age to go buy one, or I can actually buy one right now. And like you just start seeing more and more people that are getting to, like you said, that BNI quadrant. And if the government's bottom line is affected, they're going to make changes that favor themselves as a result. And so you really got to take all that into consideration and just say that I'm going to take advantage of this opportunity while it's here. So basically, you may look at this as a bad scenario. So I think you said it's 15%. That's going to be like the minimum down payment using that conventional loan. Hey, you should be looking at that as I better take advantage of 15%, because if it hits 25 or 50%, it's going to be a lot. It's going to be a lot harder. 15, 20 to 25%. Yeah, 50. That's crazy. I'm just saying, if it gets up to 20 to 25%, though, that's what you really have to take into consideration, because it could get to that point at some point, because they really want to push single family houses.
And by the way, it's there's still the FHA loan. FHA. Federal Housing Administration loan is still there. We're not saying that loan is gone. By the way, do your own research more on this, because we're briefly mentioning this. So do your own research to get more info. But this is only for conventional loans in terms of 2 to 4 units. So you can still do the conventional for the single family 5% down or 3% down. But in terms of and then you can still do the FHA 3.5% down. But look, I'll tell you this: once that FHA regulation is no longer existent, or whatever the case may be, oh man, that's how you know things is really changing, which writing's on the wall. 3.5% down, it's not going to be there forever. It's not. It's just a fact of the matter, because people are going to start abusing it a lot more, and they're going to take, because now, and I see it like this too, as we do get people learn more about it, that means they're going to have more bad apples too, people that try to abuse it and use it wrong, and the government's like, all right, bet. So I'm going to change this rule too. And so now we talked about in the episode today, they said the credit score pre-COVID, or our guest said the credit score pre-COVID was 580 for FHA. Now it's 660, right? Mm-hmm. And I hadn't even known that. So, I'm glad, that he mentioned that, because you're now able to weed out more people that will qualify, which is that's what's going to happen. I can definitely see it at one point being 720. That's a fact. So
The standard just raises, and that like you said, weeds out the like few and far between, like the people who can versus the people who cannot. Basically, it weeds those people out. So yeah, take advantage of opportunities while they're here, because they won't always be here. That's a summary of it all.
Yeah, and it's definitely changing. Times are changing fast, so yeah, take advantage. But kind of transitioning into the episode that we had today. I think we had a really great episode today with Jullien Gordon, Mr. Multifamily, aka Mr. Multifamily. So we got into a lot. Obviously, we talked a lot about real estate investing, and specifically multifamily real estate investing in the residential side. So a lot of people want to get into real estate investing. So this is a great episode to get to talk about. So one thing though, that we talked about, I think I love his mentality in terms of like how he views money in general, right? And how his relationship with money. And we talk about that a lot too. I'm not going to get too deep into it because I don't want to ruin it, but we talked about that in the episode. I think the analogies that he uses kind of to describe the relationship that people have with money and based off of scarcity and those kind of concepts is very, very thought-provoking. So I really enjoyed that concept of it. And then when we talked about the real estate, he has a really, he didn't say how many units he had or how many properties he has, but he has a good number of multifamily properties all over the country. He said in Oakland, New York, or Brooklyn, and also in New Orleans. So he's got a very diverse portfolio of properties. And his strategies he uses, it might be a little different from mine, what I prefer. He talks about putting 25% down, which, if you know me, I'm not an advocate of that. But, I think there's different ways, different strokes for different folks, different ways to skin the cat. So definitely, nonetheless, the knowledge is very, very, very applicable. So.
Yeah, but I think this is going to be gold information for anybody who is living in those higher in those inflated markets, such as like New York and Cali areas. I think these would be well. This is an example, an episode that is going to be tailor made for those type of people, just because of the fact that he grew up in a environment where the real estate prices are very much inflated, and he had to find a solution. Like, do I just sit here and cry about my situation, or do I go figure out a way to to make my investments work for me? And that's really what he was able to do. And I just like his whole philosophy about, like you said, just his philosophy with money, and then connecting it to spirituality. So he provided a very good overall perspective that I think a lot of our listeners will take a lot of value from.
Yes, sir. So let's get into this episode.
What's going on, Jullien?
What's going on? Happy to be here.
Yes, sir. Happy to have you. Like I said before, shout out to Andre Hatcher for making this happen. We're really glad to have you on here, trying to use our network to continue to grow our platform as well as share with our audience. So definitely glad to have you on here, aka Mr. Multifamily. So in the building. So yeah, how we usually like to start these podcasts out is that we want to really get into the background story of our guests, like to go into their background as far as what you had, what you saw growing up, like within your household, in relation to finance and in relation to investing, things of that nature, so our audience can really resonate with your story, and then maybe even have some type of connection with you from there.
Yeah, so for me, my journey starts in Oakland, California. Son of two doctors, so I come from a lot of privilege. My parents were upper middle class, I would say, and I had everything I needed provided for me growing up. So I don't have a story of, getting it out the mud or rags to riches or anything like that. But it wasn't until I got to college and I read Rich Dad Poor Dad that I realized that my parents were not necessarily wealthy, even though they were both doctors. And I started to see the distinction between the middle class and what I actually call the asset class. There's three different classes in the world. There's the working class. They typically use their hands and work for hourly wages, and they have a difficult time leaving any kind of generational wealth for the next generation. Then after that, there is the middle class, and a lot of people are aspiring to be in the middle class. And the middle class, is it probably better off than the working class? Maybe. I don't know, because when you think about a salary can actually be slavery if you're not careful. Because once you're on salary, they can work you 60 hours a week and you don't get paid any more for that. When you're a blue collar worker and your day is over, you leave your broom at the job site, and so it doesn't follow you home, right? So who knows? When you look at some of the hourly or salary work that people do, and you actually divide it by how many hours they're actually working per week, when they're working on the weekends, when they're working in the evenings at home, their wages are probably similar to what you might see in blue collar workers, right? And so that's the middle class. And the middle class, they tend to leave a little bit of a generational wealth. They might leave a single family home that's fully paid off. They might leave some cash or stocks. They might leave a life insurance policy, and those are good assets. But where we ultimately want to be is actually in the asset class. And the asset class is a group of people who actually have acquired assets or built assets over their lifetime. And those cash flowing assets are what they leave behind. So they don't just leave generational wealth, they actually leave regenerational wealth behind, meaning that when they pass it on to the next generation, because it is a cash flowing asset, it is going to continue to pay the next generation. Generational wealth, you can pass it to one generation and they can blow it. But regenerational wealth, it is perpetual and it keeps on going and going and going. So once I saw that distinction, I knew I had to make some different choices than my parents. I didn't just want to be a doctor or a lawyer. I didn't want to follow the Cosby programming. And I knew that a single family home wasn't part of my journey immediately. Maybe I'll get one eventually, but I knew immediately that my first property was going to be a multifamily property. And here we are. How long since I read that book? Let me see. Here we are, almost 20 years later after reading that book, and I built out a significant portfolio of multifamily properties in Brooklyn, Oakland, New Orleans, and Baton Rouge, Louisiana. And now I lead the multifamily movement, where I'm teaching other people to do the exact same thing, to get to rent and mortgage freedom through their first multifamily property.
Yeah, that's really dope. And wait, hold on. Are your parents Jamaican? If I or either of them?
Of course.
Man, I knew it. I knew it. I knew. I ain't even looked at your page. I knew. I knew that you. Yeah, they was
My
Jamaican.
dad's Jamaican, so I'm Jamaican. And my mother is from North Carolina. And they actually separated when I was 1 year old. And part of it was that they were both doctors. And when you're in that kind of dynamic, and your people are leaving home at 4 a.m., somebody's on call at night, they didn't really have too much control over their schedule, even though their pay was really good. And so I knew growing up that I wanted to have more freedom, more time control, and things of that nature. Now, I respect my parents. I'm so grateful for them. But they were in life or death situations, right? They were actually saving people's lives. And so I understand why they worked in the way that they worked. But I actually inherited some of their working habits growing up. And when I actually became a professional, I got caught up in workaholism, even though I wasn't in life or death situations, because that's all I had seen around me. I saw my parents waking up at 4 a.m., going to do surgery, saw them coming home late at night. And so that's what I thought was the way to work. And now I found that one, we want to get out of the paradigm of trading time for money, and we want to get in a space where we can actually have not just ordinary income, which is what most Americans have. We want to have extraordinary income. When you look at W-2 income that people get, is the highest tax form of income that there is, right? I actually call it earned income, URNED, because you have to literally work to death to get it. And so we want to get to a space where our assets are actually affording our lifestyle. And so anytime we want to acquire a liability like a vehicle or something like that, we think to ourselves, how can I go buy a piece of multifamily real estate that will provide me with the cash flow that will actually allow me to have this particular luxury over here?
So let me ask real quick. How come then? Or okay, growing up, did your parents? Because okay, I'll preface this. One of my favorite books is called The Millionaire Next Door. Mm-hmm. And one of the principles they talk about in that book is typically you'll see, people that have high earning jobs might not be as wealthy as they necessarily should be based off of their income and their salary and their age and all of that. So they will call that, well, what Staley calls it is a under accumulator of wealth, a UAW, right? So that's like someone that you might be making $300,000 a year, but your net worth is significantly lower than what it should be for someone making that amount of money at that age, right? Or and then contrast that to someone that, let's say, is like a plumber that's making $50 or $60, $70,000, and they have a extremely high net worth just based off of how they've invested their money over the past years. He'll call that a prodigious accumulator of wealth, a PAW. And so I'm just curious, because I always feel like kind of people that kind of come from that kind of background, you know, you can grow up in privilege and all those kind of things, but you still had a, you know, mindset shift in terms of like, okay, even that is not, you know, what I want, right? Because you can come from nothing and that's easy to see that. But for a lot of people, you know, well, it might not be easy, but you can see why it'd be easier to see like, oh, I don't want that. But right, if you grow up in wealth, it might be tougher to see why do you want to do anything differently? I mean, you grew up pretty well. So I'm just curious, was that something that kind of clicked in your head too, as far as like, did you think your parents weren't as wealthy as they possibly could have been just based off of, you know, earning six figures a year from being surgeons?
Yeah, so one of my parents loved what they did and the other one did not. And as a result, one of my parents ended up dealing with mental health issues and actually getting caught up with alcoholism. And I literally saw them lose everything.
Oh, wow.
And so I recognize that if you do not have assets in your portfolio and something happens to your mind or your body that does not allow you to perform the task that you were educated to do, then you can be in a very economically vulnerable situation, despite the fact that you had high income before. And so seeing the two different paths that my parents ended up on, one who loved their job and still does it today, even though they retired, and one who is no longer in the profession, despite having great income at a particular point in their life, I saw how just having high income wasn't enough. We see it with athletes all the time. Yeah. They have this 5 to 10 year run in a professional sport. They make 25 million in that period of time, and if they're not careful, they can lose it all. And a lot of times, you know, outsiders who aren't athletic and things of that nature say, "Oh, if I ever had $25 million, I'd never blow it." Yeah, wait till you get it, because more money doesn't necessarily solve your problems, and it doesn't address your mindset. If you're frugal, you'll probably be all right. But at the end of the day, you never want to have fear around money, regardless of how much you are able to acquire in your life. And so there are people who come into money and have fear around money. People think that just having more money takes away the mindset of fear, doubt, and scarcity. But you can have $25 million and still have a poverty consciousness, still have a consciousness that's based in scarcity. And it is not an enjoyable experience, despite what your bank balance might look like in comparison to the average person. And so really where I want to get people to spiritually, actually, I call it financial spirituality. I want to get people to a place where they have a different relationship to money. I'm writing a book right now, or I've written a book right now called Rich and Righteous: The Spiritual Secrets to Mastering Money, Your Mind, and Manifestation. And in the book, I define wealth consciousness as relating to money in the same way that you relate to air, right? None of us woke up today worrying about how much air was going to be there. We trusted that our creator, however you define that, whatever you call it, you just trusted that your creator was going to provide you with enough oxygen today. You didn't care if you saw somebody running a marathon this morning or doing their jog. You weren't worried about whether they were going to take up all the oxygen. You just woke up and you trusted that my creator is going to provide me with enough oxygen today. And wealth consciousness is when you're able to relate to money in the same way that you relate to oxygen, where you actually don't worry about it. Wealth consciousness is actually not thinking about money all the time. You know, they say, I got my mind on my money and my money on my mind. That's typically worry about money. Wealth consciousness is actually when you actually don't have to even think about or worry about money, not because you're making a lot even. It's just because you trust that if you are walking in alignment with your purpose and you were doing what you were created to do, that your creator, again, however you define that, is going to supply you with everything that you need to be able to do and fulfill on your purpose. Why would your creator create you for a purpose and then not give you everything you need to succeed at that purpose? That makes no sense whatsoever. That would be a cruel creator, right? And so I think we have some from the spiritual side, for those who grow up in certain religions and things of that nature. I think we have this negative relationship to money. You hear things like money is the root of all evil. No, it doesn't say that. It says the love of money is the root of all evil. And it's not just the love of money, it's also the lack of money is the root of all evil. Because why? Because neither of them allow you to walk in your purpose on a daily basis. And so until we renew our relationship with money, it's economic oxygen, and we have to establish a better relationship with it, a healthier relationship with it, regardless of how much you have. Whether you have 5,000 in your account right now, whether you have 5 million in your account right now, I encourage everybody to ask themselves, what is my relationship to money? There's no reason that this green piece of paper should have as much power as it does over us as human beings. But most human beings allow this green piece of paper to dictate who they are and how they show up on a daily basis. And so I don't believe in the almighty dollar. I believe in an almighty God, and I seek to serve my creator first, knowing that all the things, all my needs will be met, and that when I seek ye first kingdom of God, then I know that all things that I need will be provided unto me. So that is how I move with money, and it's a different approach. I mean, there's all kinds of cutthroat approaches, 48 laws of power, do this to get over on people, here's how you influence people, all these ways of trying to acquire money. The way I actually do it is different, and I do it by trusting in my creator to guide me. And as a result of doing that and being walking in my purpose full time for over 10 years now, I'm experiencing more abundance than I've ever experienced because I stayed the course. Literally, my work started out as workshops in my living room in Brooklyn, New York, and to see the impact that I'm having now through the multifamily movement, where I have hundreds of students closing on multifamily properties, to see the revenues that are coming into my business, the money that flows to me and through me on a daily basis. I couldn't have known at your age that this is how it would have unfolded, and that the abundance that would be in my life as a result of just staying the course and walking in my purpose. I mean, I quit my job January 9th, 2009 at the bottom of the last recession. At the bottom of the last recession. Right. So I know what people are going through now as they feel that the economy is contracting and unemployment rate is up and things of that nature. I knew that in order to make it through that time in my life, that it wasn't going to be a hustle hard. I went through that space of workaholism, trying to do it on my own, trying to rely on manpower. But there's something greater than manpower, and that is being able to tap into manifestation. And so manpower is when you rely on your hands to create, but manifestation is when you rely on God's hand to create. And I know that God's hand is having this effect in my life, and I can tell by the fruits that I'm able to reap.
Man, I can tell just by everything that you just said that you're very philosophy driven. Like your philosophy is heavily spiritual based, and I love everything that you and how you try to relate wealth and spirituality both together, and and show how similar they should really be in somebody's life, especially when you're talking about wealth consciousness. In reference to you're not going out and worrying about, are you going to have air today? Like, just imagine if somebody was woke up this morning and said, okay, I need to work 1 hour in order to get 30 breaths of air for this hour. Like, nobody's thinking like that. They wake up and they just know that their needs will be met and on that regard. So if you're moving in your purpose as far as trying to obtain wealth for your life, you should be moving in the same space, not really worrying so much about it, just knowing that God's gonna take care of everything, or whoever you believe is gonna take care of all of your needs. I love that philosophy, and I really started thinking back. Well, something else that you had mentioned earlier was talking about how your parents had gone through that mental health issue, and that they had pretty much lost everything. And that just reminded me of how, like, people will rely on their bodies too much in order to make their income. And I think that's a big pivotal thing that people need to take into consideration when it comes to getting passive income. Because if your body fails and your line of work requires your bodies, especially like star athletes or anything like that, they really are one injury, one bad break away from losing all of their income altogether. So you had to have some type of passive stream coming in for you.
100%.
Yeah. And
So,
go ahead. I mean, if you wanted to say anything.
oh no, I was going to transition it to kind of
Yeah.
moving the story along, just in regards to, how you got into multifamily investing and what, made you click in regards to multifamily as opposed to, another type of investment. I know you mentioned single family houses wasn't something you were interested in based off of, that whole American dream concept of the middle class. So what made you, gravitate towards multifamily specifically?
Yeah, so there's four things that happen when you acquire a multifamily home that are completely different than a single family home. American Dream will tell you that a single family home is an asset, but the reality is that at no point does a single family home pay you unless you sell it, and if you sell it, you no longer have a single family home. So, and then a lot of people say, oh well, Julian, I paid off my mortgage in 15 years. I don't have a mortgage or whatnot. That's fine, but now you have a 15-year-old home or a 30-year-old home, and guess what happens? Your mortgage becomes maintenance, right? Because now you have this old property. You don't just buy a property and it just lasts forever. Now you have to do that roof. That's $10,000. Now you have to redo the foundation. Now you have to do the entire electrical, right? So you thought that you had paid it off, but your house is still costing you on a daily basis. Not only the maintenance, but the utilities, the property taxes, and the insurance. So there are single family buyers, quote unquote homeowners, who have more money going out of their pocket every single month due to housing than there are some people who are renting the same square footage across the street. But Julian, it's a good savings account. Yeah, it's a savings account, but the money is stuck in the walls of your property. It's stuck there. You can't use it. And your first mortgage payment is 70% interest. So tell me, what kind of good savings account is that where you put in $1,000 and you only get credited for 300? How is that a good deal, right? So the American dream has pushed people towards single family homes, but when you buy a multifamily home, my first property was in Brooklyn in 2013, and it's a triplex. And the moment I got the keys to that property, I knew I wasn't a home owner. I was a home buyer. And we have to be very careful with this language because HGTV will fool you and tell you that you're a home owner. And the reality is you're not. You own 3.5% of the home. The bank owns the other 96.5% of the home. On top of that, people are like, well, Julian, at least I ain't paying rent no more. Well, the reality is you are still paying rent. You're not paying rent to a landlord. You're paying rent to the bank to use their money. It's called interest. You're renting the bank's money. So you're still paying rent, but it's called interest. So because people don't understand this financial transaction that is occurring, they think that they've won. And the only way you win in single family real estate is if your home happened to appreciate. Okay. If it happened to appreciate, which you actually don't control. Hopefully you bought right. And even if your home does appreciate, right, then that appreciation typically only covers the interest that you were paying to the bank anyways. So I knew that multifamily was a route that I was going to go. And when I acquired the keys to that multifamily home in 2013, May of 2013, I have not made a housing expense or paid a housing expense, rent, mortgage, property tax, utility, insurance. I have not paid anything directly out of my pocket for the past 7 years of my life. What would change for you if you no longer had a housing expense for the rest of your life? If you, for let's say your rent is $1,000 right now. If you invest $1,000 every single month at 6% for the next 30 years, you would be a millionaire. You'd have 1 million, about $15,000. So literally, if we can stop you from paying rent or stop you from paying a mortgage payment, literally, I have a proven path for you to become a millionaire, right? If we can just get this big expense off, because for most people, their housing expense is about 35% of the money that they bring into their household. So if we can just literally change that one thing, it's going to change the financial trajectory of your life. So I bought that property. The rents from the third floor and the second floor paid for the principal, interest, taxes, insurance, capex, repair reserve, vacancy rate, and still left me with cash flow on top of that. So not only am I living for free, I'm getting paid to live. Okay. And that's just the cash flow portion. On top of that, that property is appreciated by over $300,000 in the past 7 years. So you get the cash flow, you get the appreciation, you get the principal pay down, right? And you get all the tax savings from being able to depreciate this property over 27.5 years. So there's 4 financial benefits that you get from actually having multifamily instead of buying single family. So that's why I'm so committed to this, because I know that this one single decision can change the trajectory of somebody's life. The only other 2 decisions that could probably have an equal impact on your financial trajectory is perhaps a career path that you choose and who you decide to marry. But besides that, you buying a multifamily property as soon as possible is going to probably have the most sustainable and an impactful impact on the financial trajectory of your life.
Ooh, see Alex smiling over there.
Nah,
You're
'cause
talking our language right now. for sure.
yeah, he's preaching because we always like to say too. I mean, I know for me, I think the number one financial mistake that I always see people make is to go buy that dream house as soon as possible, right? As soon as you graduate, they want to go buy, and it's not, it's not even their dream house. It's just the most house they can afford, right? In terms of the single family, the bank says, hey, we'll give you 500,000. They go and find a house that's 498, right? Just because now, that's the thing that they can get. It's going to be, 3,000 square foot new construction single family house, right? And it's always interesting because, I always think of the whole concept of single family versus multifamily in the sense of like even thinking, single family houses weren't even ever meant to be operated necessarily as a business, right? They're literally, they were built to literally house people and to also just keep pretty much store items, right? They were never necessarily meant to be operated as a business, as opposed to multifamily homes that were literally designed and are even on a larger scale evaluated based off of income. So they're being looked at and evaluated on a business mentality. So it's always like a kind of a conundrum in that sense, because it's like you can always go try to make a deal work as a single family rental property, whatever the case may be, but it's very rare that you're going to get a good cash flowing single family house, because it's just not meant to cash flow. It's not meant to cash flow. Like, it's just the way it's set up is just not meant to cash. Economies of scale, all those things aren't working in its favor. So I love it, man. I mean, we could we could go back and forth all day on this, Marlon. I know you want to mention something about it as well.
Yeah, so we've been talking about this concept. So we found out it was coined house hacking. We've been talking about this ever since episode 5 of the podcast, and that's something that we both have been advocates for, because we both done it ourselves over the past few years. So that's been something that's really allowed us to save a lot of our money and be able to take more financial, what other people would consider risk, so such as like starting a side hustle or business venture. We can take those type of risks because of the fact that we have that extra income that's paying for our largest monthly expense. I always talk to people about, like, if you look at your entire all your monthly expenses is like in like a pie chart formation. You're gonna have that big chunk that's 35 to 50% that's your housing. Then you're gonna have a whole bunch of other expenses like food, gas, entertainment, things of that nature. But those are all much smaller percentages. And if you ask somebody how should they start saving money, they're always going to start targeting, okay, maybe I should get rid of this Netflix subscription. Maybe I should stop going out to get my Friday coffee or whatever. But instead, nobody wants to really attack that big elephant in the room, that big 35 to 50% expense, which is your housing. And people will just be like, well, you want me to live on the street? I'm like, no, you should be trying to get that multifamily property, one where you can live in one unit, rent out the other ones, and allow that to pay for your large monthly expense. And that's something that we've been talking about forever. It just helps out so much as far as allowing you to be able to build that wealth, like you were talking about earlier. So just based off of that, what did this first investment allow you to do moving forward into multifamily?
Yeah, well, it did allow me to take more risks, exactly as you said, because you know that especially in New York, where rent can be extremely high, you know that your housing is secure forever, right? And so I was able to expand my business from there. I was able to take cash flow from that property, as well as any cash flow that was coming from the business, and I was able to pour it back into the business. We are in the business of circulating money, right? We're supposed to circulate money to ideals, ideas, individuals, and investments that we believe are doing good and they are going to expand. And so that's my role as a steward of the economic resource that I've been blessed with. That's what I'm supposed to do. And so I was the number one asset that I was able to invest in was myself and the businesses that I was building. First, it started out as my speaking business. I was speaking at colleges and then companies. Then I wrote my first book, and then I was doing my own workshops. Then I had softwares and masterminds and things of that nature. So I just kept pouring the economic resource back into the growth and expansion of these ideas that were coming into my head, and definitely not having to worry about housing or think about that payment whatsoever helped free me in a way that allowed me to do that.
And so how are you kind of, obviously now you say you've built a portfolio of multifamily homes. How are you, financing a majority of them at this point? Are you still continuing to, because, one of I know some people are big advocates if you house hack as many times as you can, right? You can house hack every single year. If you, can go, get into one of those owner occupant multifamily properties every single year, use the FHA, use the conventional, whatever the case may be, to get to accumulate that portfolio. So what are your strategies now and then that you're pretty much implementing to continue to build your portfolio up?
Yeah, I just house hacked the first property. That was it. And given that I was in New York, I knew it was going to be hard to buy another property there. 25% down on $1 million property is $250,000, and so I wasn't making bread like that at that time. So I knew I was going to have to find a smaller, less expensive market if I wanted to build my real estate portfolio, and that's what led me down south to New Orleans and into Baton Rouge. I've done all my properties conventional, 25% down, but I was in a smaller market. So whereas a duplex in New York might cost 700,000, a duplex in New Orleans costs 200,000. So 25% down on 200,000, that's 50,000, as opposed to trying to put down almost $200,000 on a duplex in New York, right? In real estate, there's the 1% rule, and you want to make sure that the rents meet that 1% rule. And it's very hard to do that in New York or California. So in those states, you want to make sure that you're buying for appreciation because cash flow is probably going to be slim. So in New Orleans, it made sense not only from an appreciation standpoint, but also from a cash flow standpoint. And so from a distance, I was investing in New Orleans. I bought several properties here before I actually moved down here. I tell people all the time, your money does not have to work in the same city as you do. You own Amazon stock and never been to Seattle. Okay? You own Nike stock and never been to Beaverton. So your money does not have to work in the same city as you do. Dead presidents, they are your employees. George Washington is my employee. Benjamin Franklin, they are my employees. And if I need to send them somewhere to go make money for me, then so be it, right? So that's what I did. And I think a lot of people have a mental block around finding a smaller, less expensive market. How do I do that? You're going to need a great agent on the ground, some people whose eyes you trust, who understand multifamily real estate. And you're going to need a great property manager. And hopefully that those two people come with the real estate Rolodex of plumbers and contractors and electricians and things of that nature to execute on things that come up when tenants need them. So that's how I built my portfolio. And then in this next phase of portfolio development, I raised a $3 million fund with my brother Anthony Kimball to develop 160 units out in Baton Rouge, Louisiana. So we crowdfunded that, and as managing partners, we own part of that fund, and then I'm also an investor in the fund. So I own a significant portion of that fund based on my partnership and based on my investment. So the next tranche of my portfolio, as opposed to just going and continuing to get it individually, I could have done that and just said, you know what, forget the people, I'm just going to get mine. But I wanted to create a space where people who were having difficulty getting finance could actually be real estate investors, even if they were having difficulty getting finance for their own property. So I decided to raise a fund. And so my next group of investments will actually be a fraction of that portfolio. So I won't own those doors directly, but I'll own a percentage of a larger portfolio that we're developing out in Baton Rouge, Louisiana.
That's solid, man. I remember there's a quote that says, if you want to go fast, go alone. If you want to go far, go together. And that's something that I'm seeing, because what was it? You said 160 units that you're developing out in Baton Rouge now. And that's not something that you would just get into just based on like your current income or anything like that. You want to like syndicate that deal. You want to have multiple investors in so you can attack a bigger overall property or a bigger overall project, as opposed to just a triplex, a single family or something like that. I think that really goes a long way when you are willing to accept others or build a team around you in order to attack bigger projects and give basically a better overall return for everybody involved. Mm-hmm. I think that's one thing that we, as in our Black community especially, are just opposed to. I think from birth, I don't know. It's like something that we were trained in. It's like just more of a selfish mentality, not really wanting to share with anybody else. But if we can really break that barrier of being selfish and just allowing more people to share the wealth, I think that we can really start expanding as a whole, just in general.
Yeah, so last year with that fund, I created about 440 real estate investors who contributed to that fund for $3 million. And then the multifamily movement, we've had over 100 closings. So over 100 of my students have closed on their properties. And if the average property is a triplex, that's 300, and if the average door produces $300 per month, that's $90,000 a month. And so right now my students are going to be cash flowing over $1 million collectively per year based on the teachings that I've given them to make sure that they can buy multifamily real estate the right way. So that's powerful. And this is just the beginning of the movement. Our target right now is 300 because that's how many people Harriet Tubman freed over the course of about a decade by making 19 trips below the Mason-Dixon line. So we're moving for 300 in the multifamily movement. Yeah, that's our focus right now.
So let me ask real quick then, just another question in that regard of kind of what you're teaching people. So, you know, one of the strategies that I love using, especially for real estate investing, is concept of the BRRRR strategy, right? In order to, essentially where you buy distressed properties, renovate them, and you increase the value, and you can refinance them and pull your cash out. So, you mentioned that you were, buying a majority of your properties, 25% out down south, just based off of the, geographic economics, and the, feasibility with putting, that amount down. Are you teaching other people are you teaching people to invest in that using that, or are you teaching people other creative financing strategies such as the BRRRR method, or what does that look like? And what do you think about the BRRRR?
Yeah, so multifamily movement is just traditional 3.5% down FHA. That's the multifamily movement, right? Because some folks don't have the chops to actually take on a distressed property, right? But in our advanced program called How to Buy the Block, we do teach the BRRRR strategy. And I've actually, I would say, what was it, around my fifth property, I started BRRRRing to develop my portfolio. So most people only BRRRR single family homes. I BRRRRed a fourplex here in New Orleans, right? So it was acquired for $330,000. And we put in 110 to it, so we're 440 in, and it appraised at 660. So when I can, I BRRRR multifamilies if possible. When I go in and I see a ceiling falling in, that excites me because I know I'm about to walk into a deal. But most people aren't ready for that because they've been trained by HGTV to look at real estate from an aesthetic standpoint as opposed to as an asset. So they go in there and they run out the door, but I go in there and I actually run the numbers. I don't run out the door, I run the numbers. And if the numbers make sense, then I go ahead and move on that deal, and I have the capital to be able to move quickly. So so the multifamily movement, again, it starts with the traditional FHA, right? But then as students get advanced, after people buy their first property, then from there, we get into more advanced strategies.
I love that you mentioned that, because that's one reason I love the multifamily asset class in general, is just because I know most of the time you're not going to be competing against those retail buyers, right? Those people that just want to, they're looking for the, the cute porch or the big yard for Fido to run around or whatever the case may be. You're competing against, those people they're willing to pay ridiculous amount of money, even if the house is not appraising, they're still going to, try to buy a house at a certain price as opposed to an investor most of the time. You're competing with a lot smaller pool. So, that's one reason I think multifamily is definitely the way to go when it comes to building if we want to talk residential portfolio of properties.
Sorry about the dog. The dog, I hear the dog.
Yeah, just a little bit.
Hey, we're going to take care of it. Sorry about that.
Yeah, Alex lives in the garage right now, and his tenant got a dog as well. So we've had several times on the podcast where the dog just go crazy. So it's all good, man. But what was I going to say?
They feeling the game. I think they feeling the game.
Yeah. Yeah, for sure. Okay, that's right. So yeah, with the current way the economy is, like I would say this is like one of the high points for real estate just all around the country as far as like the housing prices, even with multifamilies in general. It's multifamilies and single family. So in your case, when you are working with your people in multifamily movement, like how are you showing them how to find these deals? Because like for instance, you said you just did that multifamily deal, 330,000, that was the purchase price, 110 for rehab, and it appraises for 660. That's a 66% all-in project deal, so 66% of the ARV. And so now, where you find these type of deals at, and how are you showing your all your students how to find them as well?
Yeah, so our focus is off-market deals. But before getting into off-market deals, you just gotta have to know how to run the numbers. But people all know what an off-market deal is. If you ask anybody, what store do you have a hookup at? They'll all tell you a store. They'll say Macy's, Best Buy, all these stores, and you ask them, how do you have that hookup? I got it through my homie, a friend, a relationship. Well, that's great. That's an off-market deal. So you know what the concept of an off-market deal is. You just have off-market deals on expenses and liabilities. And we're trying to teach you to have off-market deals on assets and income, right? So people understand the concept of off-market deal. Again, they're using it for the wrong things. And so I teach them how to build their real estate Rolodex so that they have off-market deals coming to them from different directions, from agents, from wholesalers, from contractors, etc. And then they have to be ready and be able to confidently run the numbers so that they can make a strong offer to get that deal under contract.
Yes, sir. Are you muted, Alex?
Mm-mm.
Okay, cool. All right, well, I really don't have any other major questions. I don't know if Alex, you have anything else. I'm gonna get ready to wrap it up and then move to the Fast Five after.
No, you can go into that.
Okay, cool. So yeah, before we get into that, my last question I like to ask every guest is where do you see yourself going moving forward? What is your ultimate end goal now that you built this success up to where you currently are today?
Yeah, so the larger focus is probably going to be 10,000 multifamily real estate investors created, and we will be what I've uncovered and discovered. Again, walking in my purpose, I realized that the multifamily movement is just not about multifamily properties. It's multiple families coming together to create generational wealth. So in terms of the Buy Back Baton Rouge Fund, a lot of my students actually invested with me at that level. So we're working together to create wealth as one big family. So multifamily movement for me means multiple families coming together to create generational wealth. The first asset that we're seeking to acquire in order to do that is, of course, multifamily real estate. But then from there, we go to multiple streams of income. And then the ultimate goal is to create multimillionaires. But, there's a lot of get rich quick schemes out there. This is get rich guaranteed over time. And so I believe that my students and those who are working with me are going to be with me forever, essentially. And when we look at the balance sheet and net worth of the people that I'm leading right now, I expect us to have billions and billions of dollars under our control that we are using to create more good and more God on this planet.
Yes, sir. It's a lot of good stuff right there. So I guess what we want to do now is transition to the final segment of the show where we do our Fast Five, where we ask each and every guest 5 questions and they answer in 10 seconds or less. Alex takes the first question, then we alternate afterwards, so we can get started there.
So the first question, what does success mean to you?
Purpose and alignment.
Yes, sir. All right, question number 2. What's your favorite money or business book?
Favorite sales book is Green Eggs and Ham. I'd have to explain that, but I don't have.
Go ahead. No, go ahead and get into it. I'm curious.
So Green Eggs and Ham is one of the most valuable skills in your life will be learning how to sell, right? Whether you're going to an interview or you're selling a product, learning how to sell is really important. Green Eggs and Ham, Uncle Sam, is selling the other character on Green Eggs and Ham. The other character doesn't know if they like green eggs or ham or not. Sam is like, I know you'll like them. And so Sam makes about 26 offers throughout the course of that book, inviting the character to try out green eggs and ham. And at the end of the book, what happens? The character likes green eggs and ham. And so I believe that it's one of the greatest sales books of all time. I think Dr. Seuss got rejected 25 times before he got his publishing deal. So I think that's where it comes from.
Yo, that's a very good answer. Never heard that one. That was that's a new outlook on that book for sure.
I don't even think I've read Greens and Eggs and Ham. I might have to go
pick it up. That's gonna be on his book list now.
I have to add it on there. So next question, would you rather have $1 million today or $1,000 a week for life?
Definitely $1 million today.
Why is that?
Just a 10% return on that. 10% return on that is $100,000. Divide that by 52 weeks. That's $2,000 a week. So as long as I can get that to perform at 10%, then I'm going to be making more than $1,000 per week, and I'll still have $1 million.
I like that. We've heard so many different variations of that it's cool to hear all the different perspectives. That's dope.
Sir. All right, question number 4. If you could go back and change anything about your journey, what would it be?
Nothing. I'm so happy with my life. I believe that everything happened for a reason, and every part of my journey I'm grateful for, even the ups and the downs.
Yes, sir. That dog going at it.
I'm so sorry, y'all.
No, it's good.
Neighbor.
You need to start paying rent for all that noise.
Yeah.
But last question then. Where can people find out more about you?
JullienGordon.com. But the number one place is actually IG. It's JULLIEN Gordon, GORDON. That's JULLIEN GORDON on Instagram.
Dope. Well, this has been super dope. I think you've came and you've added a ton of value to our audience, which is always a goal. So we appreciate you coming on here for that. You know, I think definitely people need to definitely tap in with you and get into that multifamily movement because, you know, actually real quick, one thing that I did want to mention briefly, because I had seen this last week, someone had sent this to us about how, you know, some of the rules around multifamily are actually kind of changing with the Freddie Mac home path thing. So I did want to, I should have asked this earlier, but it just hit my mind right now. Could you kind of like talk briefly about like kind of, because one thing I always say is that, look, times are changing. People need to take advantage now before things change, right? Because things aren't going to be how they are in the future. So can you kind of talk about that briefly and what that entails just for, you know, people to understand that? If you have...
We're expecting some new changes and policies to hit as of the 1st of April. Some of it's going to be stricter guidelines that Freddie and Fannie put down for multifamily properties. So you're going to have your A game tight. You know, FHA was 580 credit score before COVID. I mean, you could F up your credit and still have a 580, right? But then during COVID, it jumped to 660, and then it jumped to 660, and who knows what's going to occur and what number they're going to choose for this particular set of guidelines. On top of that, every lender, to protect themselves, can add on layovers, right, and make their guidelines even tougher to get financed. So fortunately, we have a strong network of lenders in the multifamily movement who were able to make sure that our students get finance and things of that nature. But that can mean higher interest rates because you're perceived as a higher risk. It can mean higher down payments, right? Some lenders will only finance for 2 families. Some lenders will finance for only 3 families, etc. So you don't want to procrastinate on these things because it puts you in a position where you've missed out on an opportunity. But a lot of people are sitting on the sidelines, not aware that they could have been playing this entire time because they just didn't know. They thought that real estate was too expensive, and as a result, but when you ask them where did they get that number from, it came from their own limited thinking. It didn't come from racism. It wasn't sexism. It wasn't anybody else. It was their own thoughts and own limiting thinking about real estate that kept them on the sidelines when they could have been in the game 2 years ago, right? So guidelines can always change, and the lenders have the right to do that. You're going to have a place to live for the rest of your life. It's extremely important and powerful to make sure that space is actually free to you, that you are getting paid to live. If you don't do anything, there's all kinds of wealth building strategies, from stocks to stock options to cryptocurrency, this and that. Cryptocurrency could come, it could go. Stocks are going to be here. Stocks go up and down. But if you don't do anything, please go get you some multifamily property, period. All right. That alone is going to change the financial trajectory of your life.
And that's it. We're gonna end it right on that.
Sure.
We're gonna just drop the mic. That's it. So we appreciate you, bro. This has been dope.
Indeed, and grateful for you. So happy to see you coming into this awareness at the ages that you are, and not only coming into the awareness, but actually moving and acting on it. So it's a beautiful thing to witness. I just know and wish abundance for both of you. Stay close to each other, and whatever your vision is, I just challenge you at your age where you are unencumbered and things of that nature. I encourage you just to think 10 times bigger than what you're thinking right now, because there's so much that's possible for you. Time is on your side. And you can absolutely build and create whatever it is that you want. So don't think small, and just go for it. Whatever comes to you is yours. So that's what I would say.
Well, that's it for this episode of the Money Monopolizers podcast. New episodes will be released every Thursday and will be available on Apple Podcasts, Spotify, and YouTube. Just search Money Monopolizers wherever you listen to podcasts. We hope you learned something of value today. And if you did, We'd appreciate it if you rated us 5 stars and left us a review on Apple Podcasts. You can also find out more info about us on Twitter at The Monopolizers or on IG at Money Monopolizers. We post informative content on there. That'll definitely keep you engaged. So be sure to check that out and share those posts. But until then, we're out of here.
You've been listening to the Money Monopolizers podcast, helping you take control of your financial destiny. To learn more about how you can be in control of your money, visit moneymonopolizers.com. We'll catch you next time when Alex and Marlon share more personal finance and wealth creation tips with you. Now it's time